Nobody's going to tell you what to do on a day-to-day basis. There is no blueprint for success here.
Goldman Sachs, people dream to have positions in those companies. You were there and you jumped out. What were you thinking? What was going through your head?
Actually, I have a former colleague, he used to joke this, it's the one career path that people walk away from pretty much guaranteed to become wealthy.
How do you personally balance patience with pressure to deliver results in the short term?
I'm definitely blessed to have, and some of it was self-selecting. Our team here, our partners here at Roundhouse, we kind of all share the longer-term mindset.
Can you recall a moment when you had a high-stakes decision and what was going through your mind at that time?
There are lots every day. Every deal we do, there's an inflection point when you're about to go non-refundable on a deposit. It's really stressful always.
Welcome to another episode of the Dealmakers Chronicles. Today, we're joined by Michael Caldwell, Managing Director at Roundhouse. Welcome to the show, Michael.
Good to be here. Thanks for having me.
Absolutely. We're excited to dig in and ask you some questions to learn a little bit more about you.
So, Michael, take us to the very beginning. I know you have a background in investment banking. How did you get into real estate? Take us pretty much to your path.
Yeah. So, like a lot of people who end up in the real estate world, I have a family connection to the business. My father was a commercial broker and investor for majority of his career. Still is, actually. Like a lot of guys in this business, he has a hard time giving it up. So I grew up in a family where I was just exposed to the investment real estate world from a young age. And I can remember walking properties with my dad on weekends when I was a little kid. And, whether it was something he was looking at for personal investment or, property he was brokering for sale. So I always kind of had that DNA in me and that interest in for my career. I kind of took a bit of a circuitous path to get to where I am now. As you noted, I was in investment banking previously, which was I got into investment banking after business school, and ultimately, it was a good stepping stone. It was a good training ground, I was initially covering industrial companies at Goldman Sachs, so it was covering an entirely different sector. We can get into kind of all those experiences, but ultimately, I got to a point where I knew I wanted to once and for all kind of make the switch with my career to focus on real estate. Was pretty open-minded in terms of which sector of real estate I wanted to focus on, but used kind of my experience at Evercore and finally the real estate investment banking group as that stepping stone. And I got connected with Roundhouse in early 2020. I had known about the company. Our CEO, Casey Lynch, who founded the company with his co-founding partner, who's now retired. They were in business school at UCLA when they actually founded the company, many years before I joined the company, but kind of knew of them and their story. They were pretty, as you can imagine, well-known, around the halls of UCLA, Anderson, given their success. And when I found out they were hiring, I reached out cold, and turned out they were looking to move their headquarters at that point to Boise, Idaho from Los Angeles. My first email exchange with them, our COO, Katie, said, just to make sure the job is going to be in Boise, not LA. I think I was living in New York at the time. She was thinking I wanted to move back to LA. And I had some ties personally here to Idaho. And so I said, perfect, even better. That sounds great. Let's meet. And she happened to be in New York the next week, and we met. And over the next couple of months, the pandemic hit, and a lot of things happened. But they accelerated their move here to Boise, and I kind of made a deal to join them in August of 2020 and focus on acquisitions at Roundhouse. So a lot of different experiences led me to where I am now, but glad it took the path it did.
So was it a learning curve for you to start doing acquisitions? Because investment banking, and just, to go back to what you said, you were working for Goldman Sachs, Evercore. These are top of the line investment banks. Like, you pretty much know, you have an understanding of what your career looks like if you just climb the corporate ladder. These are very lucrative positions. What makes you, I don't want to say start over, but kind of shift gears so much to like a brand new position in a new industry as well. Like what's going through your head? Are you nervous about it? Because Goldman Sachs, I mean, people dream to have positions in those companies. So that's the end goal for anybody who does investment banking. You were there and you jumped out. Like what were you thinking? What was going through your head?
Yeah, no, it's a good question. Actually, I have a former colleague. We sat close to each other. He was in the oil and gas group at Evercore, but he used to joke that obviously there's a lot of turnover in investment banking. And he used to joke that it's the one career path that people walk away from, pretty much guaranteed to become wealthy. And a lot of people make that change in spite of that. I would say, was I nervous? Yeah, for sure. Did I, take a risk? Absolutely. I think, I was at an inflection point in my career. At that point, I had been in investment banking for about 4 years. Prior to business school and prior to investment banking, I worked in private wealth management. So kind of grew up, working at large financial institutions. Evercore is obviously smaller, but kind of in the same tier of in terms of prestige and things you're working on. And I was kind of at this point where I was right on the precipice of being promoted to vice president, which is really the I would say point where you have to decide, not that people don't leave after that to go do other things, but it's a point where you're like, okay, am I going to do this as a career and be a career banker, and kind of sign up for all that entails? Or do I want to step off kind of this treadmill and do something different? The benefit of working in investment banking, obviously it's great training grounds. You're a bit like an inch deep and a mile wide, in terms of you touch a lot of different things. I mean, even just in terms of real estate, like I worked on retail transactions, worked on multifamily, worked on office, worked on all kinds of different transaction structures. So you get to touch a lot. You're not necessarily like the expert in any one sector or subsector. But it's great experience in terms of, a wide swath of things you work on. But ultimately I just kind of looked at the trajectory of my career and decided I wanted to honestly do something more entrepreneurial kind of at that point in my career, whereas I think investment banking becomes very entrepreneurial when you were the senior banker in your group, or one of the most senior, kind of responsible for covering a certain subsector. But until you get to that point, you're largely just being dictated. This is what we're going to do. Go execute on it for me. And so I wasn't really excited about spending another 5-10 years to get to that point. And I always had a desire to be on the principal side and making investment decisions, the same way, the clients that we were advising were doing. I looked at those people in those seats and said, you know what, this is great experience. I'd rather be doing that. And so, yeah, I had, after a couple of years at Evercore, I had the desire to start looking around, see what kind of buy-side opportunities are out there. Honestly, I was pretty open to, as I said earlier, open kind of in terms of real estate subsectors, open geographically. Would have stayed in New York, would have gone back to LA, would have, within reason kind of gone where the best opportunity was. Never in a million years thought that best opportunity would be here in Boise, Idaho, but super, super thrilled that it was.
Yeah, Evercore was recently in the news. They just purchased $196 million for a 14-man boutique investment bank, which I think kind of set the record for the smallest team for that kind of price.
Yeah, no, absolutely, yeah. A lot's changed actually since so I've been gone now close to 6 years, which is crazy. But they had, so that when I was there was the private capital advisory group, and then there's the M&A, real estate M&A group that I worked on, and we would kind of cross staff across those two groups. Now I think I forget exactly how long it was, but a couple of years after I left, they merged those two groups, and then obviously they're growing, not just in real estate, but kind of across the firm.
So when you started working for Roundhouse, like take me to the first 2 weeks. You switch gears, different industry. Do you say to yourself, "Oh, thank God I made this decision," or are you thinking to yourself, "Oh man, maybe I made a mistake here. I should have probably stick to investment banking"?
Yeah. Well, you kind of alluded to it before, kind of the learning curve. Because I mean, investment banking is great technical training. Honestly, it's a great, I would say, training or platform in terms of just how to operate, in terms of, everything you do is as rigorous as possible, how to communicate, over communicate, et cetera. Just these like somewhat basic but really important skills. But I had never, had been in an acquisition seat before. And Roundhouse at that point was, we were very different in terms of our size from what we are today. But at that point, Roundhouse had never had a dedicated acquisitions person. And so I was hired, as a VP to oversee acquisitions. And I'm like, well, shoot, I've actually never done this before. I know how to build models. I know how to, I took a couple real estate courses in business school. I know what a cap rate is. Enough to kind of figure it out, obviously. But yeah, in the first couple of weeks, definitely had more than a few moments where, it was two things. It was like, I'm just going to work around the clock to figure out what I need to figure out. And, that was number one. Number two is, I'm going to try to meet with everybody. I'm not going to say no to any meetings. I'm going to reach out to as many people as possible here locally. We cover the Mountain West, so kind of all over the Mountain West, whether it's brokers, other owners, sources of financing, potential investors. Just try to, have at least ideally one meeting or call a day with a new person. Is a great kind of rule of thumb that I employed. And then, point number three is like, when I got here, is like, wow, I don't have as many resources as I used to have in terms of, just the, the research, data. At that time, we've added a lot, and I think we've institutionalized a lot over the last 5-6 years. But our team was, especially at that time, much smaller. And so I was kind of back to like, well, I'm just in the weeds doing everything myself. And honestly, I think it was a really good thing, to kind of need to go through that, and really understand, the nitty gritty of our business very well, both from an investment and a kind of asset management perspective. But yeah, I definitely had a few moments where I don't want to say questioning my decision, but just, feeling the differences for sure.
So on your day one, what are the managing directors, the owners of the company tell you? Like, here's what was the mandate going forward, or did they just said, just figure it out, go out there, we're acquiring?
Yeah. Well, to give you a sense of like what it was like then, we didn't even have like a weekly pipeline meeting. We had no like pipeline tracker. So a lot of what I was doing was creating just really kind of fundamental processes, and trying to create a system to track deal flow and opportunities. We've intentionally, as a company, never had specific targets. We have to acquire X amount this year, or we have to acquire X amount in this market this year. We have general frameworks that we work with in terms of acquisition targets. And so the leadership of the company, Casey Lynch, our CEO, and Katie Vila, our COO, kind of laid out the broad strokes, for what we're trying to accomplish. But really, it's honestly one of the things that attracted me to the opportunity originally was, Casey put it well, actually, when I was interviewing. He said, "This is a bet on yourself." And, we have an established business, we have a platform, but ultimately, like, nobody's going to tell you what to do on a day-to-day basis, and nobody's going to, there is no blueprint for success here. You have to decide how to spend your time, and go out and make it happen. And obviously, not doing it in a vacuum, making sure I have buy-in for everything. But yeah, I think that was really the exciting, sometimes scary, but the really exciting thing that drew me to Roundhouse. And I think even though as we've grown and become a lot more institutional over the last several years, I think we definitely maintain that culture and kind of flexibility.
So Roundhouse pretty much is looking to hire an acquisition person. They end up hiring you, someone who doesn't necessarily have too much real estate experience, but has a lot of institutional banking experience. Do you think that was their intention? Okay, we have real estate. Let's find somebody who understands how to institutionalize our process. And let's bring somebody on maybe who's not from our industry. What do you think was the biggest reason to why they went with you and not somebody who's been a real estate acquisition director somewhere else?
Yeah, I think, I mean, a couple of points on that. Number one, they actually had interviewed, and they were in final round interviews with a business school colleague of Katie's, who, this was before I got connected with them, and I think they made an offer to him, and he ended up going to a different firm, and I'm very grateful he did, because that opened up the door for me. But he had a more traditional background. I forget which firm he was working for previously, but had a more like traditional acquisitions background post business school. So they were open-minded, I think, to the background of the candidate. And that's kind of how we always hire. We have, again, kind of broad strokes for what we're looking for, but we're open-minded in terms of the backgrounds of the candidates we hire. I think, at that time also in 2020, Boise, Idaho was definitely not nearly as much on the map as it is today. And I think, it's still obviously very different from New York or LA or San Francisco. And so there's definitely sort of a self-selecting of people who have enough of the background, but, want to move here for their careers and for personal reasons as well. So I think because of that, you do have to be a little open-minded in terms of the background of people. But ultimately, I'd say Casey and Katie's attitudes have always been, you hire talent. There has to be obviously a baseline of experience and kind of hard skills, but you're ultimately hiring talent. And I mean, both of them are extraordinarily entrepreneurial in their thinking and their approach. They've both done every single job that there is to do at Roundhouse. And, nobody kind of gave them a blueprint or a daily list of to-dos. They just kind of had to figure it out. And so I think that, ultimately I would say, I think Casey would probably say hiring somebody with a background that's not necessarily exactly what they're going to be doing, but with good skills, who's just hungry and, has the mindset of, I'm just going to dive in head first, work really hard and figure this out. That's, I think, ultimately what they were looking for most.
Roundhouse was born during the financial crisis of 2009 with that purchase of a condo, right? From 2009 to where you guys are right now, how did the purchasing criteria, your buy box has changed? What do you guys currently focus on versus the initial infancy stages of your company?
Yeah. As you can imagine, it's changed enormously. So Casey and Mike Brown was his co-founding partner who retired close to 10 years ago now. They started at the very bottom of real estate investment world, single condo. They were still in business school at that point. They renovated it themselves. They made, quick profit, and that was they were off to the races. But when they graduated from business school, they had a business plan to buy single family homes out of foreclosure, do a little light renovation and rent them out. Originally with the idea of holding longer term and really focused on kind of a cash yield business. And this was, SFR really, it was right when SFR was just starting, kind of in the aftermath of the great financial crisis. It really, was certainly not an institutional practice at that time. And what they found was it was really hard to grow and scale a real estate investment business house by house without, turning over assets, showing performance, showing track record. And then it was also operationally hard to own. They were primarily focused in Northeast LA, so pretty concentrated geographic area. But it's not like all these houses were on the same block. So the operational challenges were prevalent too. And they had a couple of outside investors at that time who gave them the advice, like, you guys need to produce returns. So they started selling these houses. I think they bought like 40 or 50 houses over a couple of years. And they started selling them. And this was still pretty early on in the recovery. It was like 2010, 2011. And they were sort of shocked at the amount of interest they were getting. They'd have 15 offers on a home. And the economy was still super soft. And they were just kind of scratching their heads, why is this? And their conclusion, especially through a couple other experiences, doing some entitlement work and one ground up project, Northeast LA was just that the housing production model in Los Angeles is so difficult that there's going to be a looming affordability crisis. And they had done some smaller multifamily investing after kind of along the way. But around 2011, 2012, they decided to start looking to other markets. And I think they visited like 40 markets in the Western US, really searching for a few key criteria: affordability, business-friendly climate, kind of reasons, sort of lifestyle reasons that people might want to live there, whether it's, outdoor access to outdoor amenities, low commute times, just nice places to live. And that kind of, through all that process, all that work, they decided on planting a flag initially in Boise, Idaho, and Colorado Springs, relatively early on, and, did an adaptive reuse project. There was still like no mandate, no, really constraints on what they could do. But they did an adaptive reuse, development here in downtown Boise, did Boise's first ever kind of mid-rise, large amenitized multifamily project, which won a bunch of awards and very successful project. But they were early to this region, certainly. And then over the next decade, really just focused all efforts or focus on the mountain region, got into Montana, got into Utah. We've gone more heavy into Colorado. So really from like day one in the condo, today our buy box is institutional quality, multifamily, generally looking for 200 units or greater. We prefer newer vintage, year 2000 or newer. We buy mid-rise, we buy garden style. We bought a few high rises actually. And we've also legged into a couple of new markets, where we like kind of the urban basis play opportunity. Bought a deal in Seattle last year, bought a deal in Minneapolis earlier this year. We're working on another one right now. And then we do kind of large scale ground up development as well. We're building two 300 unit projects, garden style projects in the Mountain West right now. And we try to start 1 to 2 of those annually. And then the third leg or the last leg is the affordable side. So we've acquired about 600-700 LIHTC affordable units over the years, primarily here in Idaho. And then we just got into LIHTC ground up development as well, and broke ground on a 40 unit project here in downtown Boise earlier this summer. So, all multifamily, all primarily Mountain West, some Pacific Northwest, and some Midwest.
And do you guys operate as a family office, as a syndicator, as a fund? How do you, who are your investors?
Yeah. So historically, or how we started was the backing of 2 family offices, initially one, and then he brought his business partner in to invest a few years later. That's a very special relationship. They're co-founders of a consumer products company, and sort of operates as our house money. It's, I would say historically they had the capacity to fund all of our equity requirements. They still do a lot. We still do a lot with them, but as our business has grown and our equity needs have grown, we can't solely rely on their equity anymore. So we added a syndication capability, probably 11, 12 years ago now. And that network has grown over time. And so really what we've done historically is like backstop a syndication with family office capital. We've added a couple other big family office relationships over the years as well. But last year we made a pretty big shift to raise a discretionary LP fund. We raised a GP co-invest fund back in 2022, which is fully deployed now. And that was quite successful. We're really happy with kind of how the composition of the portfolio turned out. And we were asking ourselves, well, should we do that again? We kind of pair that with syndication, with family office capital, or should we kind of go, make the shift to more of a discretionary fund model? And we decided to do the latter. We'll still do deals outside of the fund if, it doesn't fit for return target reasons or geography. But we're actively raising that fund now, and that'll be the primary equity capital going forward.
And with the deals that you do you separate minor value add, ground up deals when looking to raise equity? For the fund that you're raising now, are you going to be targeting a particular type of asset class and type of build?
Yeah, so the fund is a value add return profile, and we'll include up to 20% of the fund in ground up development. So, on the acquisition side, it's a core plus the value add target. Pretty wide mandate otherwise within that. And then we can also, if we hit our development cap in the fund, for example, we could continue to do developments outside of the fund and capitalize primarily with family office money.
So you've been part of a lot of transactions across private real estate, public company, M&A, capital advisory. Can you recall a moment when you had a high stakes decision and what was going through your mind at that time?
Yeah, there are lots every day. I would say every deal we do, there's, as you guys know, there's an inflection point when you're about to go non-refundable on a deposit. And it's really, it's really stressful always. No matter, you could have the equity sitting in your bank account. It's still stressful. But yeah, most recently, I would say, we bought a deal, as I mentioned, in Minneapolis earlier this year. High-rise construction, really great basis, like steep discount to replacement cost, and high watermark trades. It's a market we've been spending a lot of time in for kind of 3+ years. We like that kind of urban recovery story, urban basis play. Markets that the shine's been off for the last several years, but that we think are going to continue to do well in the years to come, and if you can enter at a good point. So we had this thesis, and we've been hunting for assets there, building relationships, and we got this property under contract, and we're working through due diligence. And when we got close to our go hard date and went through our IC meeting, for me as the head of our investments team, I felt personally a lot of pressure that it's a new market. It's definitely a contrarian play. And, I say Minneapolis to a lot of people in our industry, and they're like, why are you going there? You're in the Mountain West and high growth, like Sunbelt sort of markets. Like, why, what are you doing in Minneapolis? I was putting my recommendation behind doing this deal. And so, for me to kind of put myself on the line like that and make that strong recommendation to the team, obviously is highly stressful. But happy that we got the deal done, closed in February, and very happy that performance out of the gate has been fantastic, ahead of our underwriting, and we're looking to do more there. So never judge a deal until it's sold, but so far so good in that market.
What are some of the things that you look for in those markets that you mentioned that no longer have the shine to it that they did, let's just say, 10 years ago? What are some of the market markers that you look at to say that, okay, this is the time for revamp, or the market is coming back?
Yeah, I would kind of bucket it into two buckets. One are kind of like the high growth markets, like a Boise, like a Bozeman, Montana, Salt Lake City, certainly some Colorado markets. Those are markets that have benefited, and we think, a lot of them will continue to benefit from outsized in-migration, outsized population growth. And in those markets, we look for relative affordability. That's, affordability is Boise is still one of the most affordable markets in the country. Rent to income ratios are like 17-18% here. So even though, rents have gone up a lot, so have incomes. And so, the relative affordability is kind of one of the key things we look at first. We look at, business friendly climate. Are companies going to want to relocate there? Are companies going to want to expand there? We look at, is there, what's the catalyst for that? Is there like a big incumbent employer that's kind of driving that growth? So, for example, here in Boise, you have Micron Technology, who's building 2 memory chip fabrication plants. investing upwards of $30 to $50 billion, depending on which report you read. And that's going to drive a lot of ancillary business growth. And then, the last piece of it, which I think is equally important, is it a nice place to live? And so that's when you go and you spend a lot of time on the ground. And we have this thing we talk about, the coffee shop index, and it's like, just go to a couple coffee shops in the city, and like, is it lively? Are people like on their laptops working, having meetings? Does it feel, hip and urban? Could you be in a city anywhere else? Is there good access to amenities? It doesn't have to just be like skiing and biking like here. It could be, the lakes in the Midwest, or good biking trails throughout the city. Just reasons for people to want to live in a place. And then the other thing I point to there is commute times. Something we look at really closely. You don't want to. The places where you have to commute an hour and a half each way are obviously very different markets, and generally not growing at an outsized level. New York's probably the exception to that, because it's a very unique city. So we look at all those things. I would say, like, with the Midwest play, or the Midwest thesis, that's more of like, we think an attractive cyclical opportunity to enter a market that, is a major market, has highest concentration of Fortune 500 companies per capita in the US. Also very affordable. Rent to income ratios in Minneapolis are 18-19%. I think it's the second most affordable major metro behind Austin, Texas. And historically, in recent history, big institutions were buying there. In some market where we own, you've got Blackstone, you've got Hines, you've got public REITs, you've got a lot of institutional ownership. They're not buying there right now, but because of all the issues the city's faced, obviously the pandemic hit it really hard. The remote work phenomenon has been really tough in Minneapolis, and a lot of people fled to the suburbs, like a lot of cities. But we're starting to see people move back. Return to office is happening. And so the thesis there is, we think, we're seeing fundamentals pick up on the ground. And we're seeing asset pricing that is some of the most attractive around, relative to other stuff we're looking at around the country. And so, we don't necessarily have a finite hold period on those assets for when we're making kind of market plays like that. But ultimately, the bet is that institutional capital will come back in a big way, and we will have bought at a great entry point.
Do you find institutional capital to be your competition in the space that you're in? So a lot of players like to stay under $35 million in deal size, under $50 million in deal size, not to compete with the bigger guys. Are you guys competing with them, or do you try to stay a little lower but still big enough to where you don't have to have them in competition, but you still have enough, assets to deploy your equity crossover?
Yeah, it's a good question. I would say, generally speaking, we're trying not to compete with them. A lot of it is depends on the point you're at in the cycle. Generally speaking, in the kind of the more secondary, tertiary markets that we play in, for example, we bought a deal in Kalispell, Montana earlier this year. It was actually the first deal in our fund. It was not an institutional group looking at that. It was off market, but there were a couple of groups circling, none of whom were large institutions. Size obviously is a governor on that. I think historically the market was like, Blackstone or Cortland or whoever it might be. They weren't looking in Bozeman, Montana, or Missoula, Montana, or Boise, Idaho, for that matter. That's definitely changed a lot in the last decade. But kind of front-running institutional capital has been a great business plan for us, and it's still, I would say, a focus. And it's hard to acquire assets in these smaller secondary, tertiary markets. A lot of stuff still trades off market, and if you don't have kind of those boots on the ground relationships, it's very hard to build scale here. And so, I think kind of aggregating that portfolio and packaging it together and selling it to a larger institution is a great strategy. over the last couple of years now, as obviously a lot of the institutions were more out of the market, given all the conditions we know well, we've been able to pick up some much larger, more institutional quality assets in markets in Colorado, in particular, that I think we at a different point in the cycle just would have been unable to buy, most likely. So we bought, for example, a two property portfolio in northern Colorado last year, couple $100 million deal, that would have been a feeding frenzy in 2021, but with all the biggest institutions, but just wasn't as competitive, and it ended up being off market actually, but it was a broken process. So yeah, we've been more active in the larger, more institutional space over the last couple of years, but I think that's more of a function of just the point we've been at in the cycle.
You mentioned before that your team has grown significantly from the early days to even the time that you've joined. Now you guys have design, construction, property management under your umbrella. What are the advantages and disadvantages of being able to manage everything in-house versus outsourcing some of those responsibilities?
Yeah. Well, our Casey, our CEO, is always fond of saying, like, you can do this business in a lot of different ways. You could do it as he likes to say, like, two guys and a laptop, and outsource everything, and like that can work really well, right? I think for us, the vertical integration came first in the construction management side. And we were developing here in Boise and controlling that sort of segment of the value chain where you're not only are you selecting a general contractor, but you're in a lot of cases you're interviewing every subcontractor. In a lot of cases, our team is introducing subcontractors to the GC, and just incredibly in the weeds to every minute detail every day throughout the construction process. Because so much can go wrong, and if you're not on top of it on a daily basis, start to finish in a ground up construction process, something's going to go wrong. It usually does anyway, but at least you can you're on top of it and you can solve issues either before or as soon as possible after they happen. So that was kind of how we added construction management, development management initially. And the gentleman who runs that business for us, Patrick Bull, has a background originally in construction management. And then we added property management close to a decade ago now. And that originally was a function of there just being zero good institutional management options here in Idaho and in Montana in particular. Graystar wasn't here then. Avenue 5 wasn't here then. And so, a lot of the business plan was also just running investments with an institutional property management execution that nobody was doing, 10, 15 years ago. And that's how the property management business started. And, again, it's about controlling as much of the value chain as possible and having that kind of hands-on ability to talk to our team, to implement changes at properties, to know what's going on with staffing, to understand, what are our contract services? How can we do this? Can we do that? And, be able to walk across the office and have those conversations rather than having to get on the phone with a third-party property manager. I would say the property management options have gotten a lot better in this region over the last, especially 5 years. But it's still hard. Even for like a Graystar, like we have more scale in Idaho than Graystar does. I think I'm right in saying that. And so, a lot of it is to have more of a scale, more of a platform. We added third-party property management to attract the best talent in this region, have opportunities for people to move up and have a career at a place like Roundhouse. Ultimately helps just create the best team on the ground to drive, good outcomes for our investors. But it's not, it's property management, as you guys know, is a hard business. And what it means is our organization which was, I think, 75 people, right around 75 people when I joined, today, including all the property management people, we're right around 225 or so. And it's becoming a pretty good sized organization, which is obviously just difficult to manage that number of people. And we just hired a gentleman as president of our property management business, so he's overseeing the lion's share of the headcount. But ultimately, I think it drives superior outcomes, but definitely brings day-to-day challenges.
Are you managing any other landlords' properties, or are you only managing your own properties?
Yeah, we are. We started third-party property management about 4 years ago, and it's primarily in Idaho and Montana, where we're I think the largest manager, and have the most scale. We have a couple of properties elsewhere, one in Denver. But yeah, just to give you an idea, we have about 11,000 units, a little less under management. About 7,500 of those are our own assets, and then the rest is third party. But we really started that business. It is profitable. It's not, high margin business, but it's really just to have more scale and be able to offer more career opportunities to people on that side of the business. And with the idea or the goal of attracting more of the best talent is kind of the main impetus.
So the owners that started this, initially you wear like every hat under the sky, right? Now that the company has grown so much, are they focusing on a particular aspect of the business? Is it acquisitions? Is it just managing the entire entity? Like, how has their role shifted since inception?
Yeah, good question. Certainly less in the weeds. If you think about our CEO, Casey, who's, co-founder, Katie, our COO, who she's been with the company about 10 years. So, she's been here for the lion's share of building it. Our CFO, Dave Buck, who I haven't mentioned, but he joined us from Oaktree. He joined about a year after I did, but super bright guy, very, experienced in institutional real estate. I think with the bigger team, just they don't have to be as in the weeds on the day-to-day of deal flow, underwriting, construction management, design of our developments, development management, day-to-day property management issues. So it's more of a strategic role, especially for Casey. He's responsible for everything at the end of the day, but he is a sort of master strategist and is constantly thinking about how should we shift our strategy, what should we be thinking about. He's one of the most well-read people I think I've ever met, and so I'd say that's probably what he spends most of his time on. The other thing is, as we're raising this fund and just raising capital in general, the founder and like the C-suite leadership, of course, needs to be very involved there. So all three of them spend a lot of time on capital raising. But yeah, I wouldn't say. I think selfishly, I'd say they probably enjoy the acquisition side of the business the most. But I don't know if I'm saying that just because it's my side of the business. But
that's the origin, right? That's how it all
that's right.
started. So
That's
they
right.
must.
Yeah, that's right. So yeah, I think they're all deal people. Like most of us are in this business, and so it's fun to talk about deals and talk about this, that, or the other. And I'd say like the investment aspect of it too. Of we're in tune with what are global capital flows and what's the fundraising environment like, and what do we think that's going to do to pricing, and just like the broad, bigger lens zooming out of like global capital markets and how that affects our little corner of the world. These are things we have conversations about all the time. And I think that's what, they spend a lot of time on and obviously enjoy thinking about.
Talking about strategy, right? You mentioned, the CEO's job is kind of the mastermind. Not every developer or group pays attention to sustainability, right? And design in their projects. You guys do. How are you able to pair that and the impact on the environment and the community that you're in with balancing with the returns that you provide for your investors?
Yeah, it's a good question. Depends on what it is. There have been instances, I don't have the exact numbers off the top of my head, but instances where, certain systems are more expensive up front, whether it's, an HVAC or maybe it's a certain type of insulation or, glazing on the windows, things like that are more expensive up front, but have lower run costs or produce lower run costs. And, if you're a merchant builder, you're not incentivized to implement those systems necessarily because you're not going to hold the property long enough to recoup that cost. I think being longer term holders of assets definitely helps us mitigate, not only mitigate, but actually make those upfront higher costs or upfront financial decisions more lucrative in the long run. Not to mention the fact that if it's good for the environment, and you're just building a higher quality property, that's never a bad thing. So yeah, I'd say the long-term hold period. And then, there are plenty of instances like, any developer, if you have something that is required for your entitlements, that's, a nice to have for the city or for the neighborhood. I'm thinking of a development in Bozeman that we finished construction on last year, required to put in a city park actually on the property and dedicate that to the city. We ended up, I forget if we were required or not, but we put in a pergola that was not inexpensive. I think we kind of went above and beyond, not because we necessarily had to, but we wanted to make a nice environment. It's a nice environment for our residents, but it's also a nice environment for the surrounding neighbors. And we take really seriously kind of the context in which our developments sit within a city, being good stewards of kind of what we contribute to the cities, and we hope we're elevating the fabric of the communities. One of our core values is elevating the built environment, and we take that seriously.
Coming from an MBA at UCLA and then BA in history from Yale, how would you say that background of education enabled you to adapt to first investment banking and now to real estate on the institutional level?
Yeah. I think starting with, history, I'd say obviously not a traditional major for somebody who wants to get into finance. But I think, what it teaches you in terms of research, thinking critically, coming up with sort of first viewpoints that are unique, that you're not just reading in a textbook, but basically compiling a bunch of information and then coming up with a unique viewpoint on it. We do that every day in our investing. We're constantly reading third-party research, and then trying to synthesize our own conclusions and thoughts about it. Not that we, have only unique ideas. We certainly borrow other smart people's ideas. But I think, being a history major helped a lot. Just like that critical thinking piece, I would call it. Also, certainly, the writing aspect of it, which I think is kind of undervalued in our business. But I write a lot, whether it's in our investment memorandums, even just basic daily communications with people. I think being able to write succinctly and maybe reasonably eloquently is a valuable skill. And then, I got a lot of technical training, somewhat in business school, but certainly in the training programs, and then just mostly on the job in investment banking. And honestly, that was one of the reasons I wanted to go to business school and get that investment banking experience. Candidly, I think I always had a stigma on my resume as the history major, and I wanted to kind of shed that once and for all.
It's funny. It's funny you mentioned that because I interned at JP Morgan Investment Bank, and my mentor actually was a history major as well, and his thesis was on the War of 1812.
Oh,
So
wow.
it was one of the it was one of the conversations we had. It's like it's a very unique major to have, and then end up working in investment banking. But
For sure.
you're not the only
sure.
one. It seems like it's one of the majors that actually ends up in investment banking.
That's right. Yeah. No, I wrote my senior essay on a battle, a particular World War I battle, in what is today Slovenia. So it's like, that's totally irrelevant, right? To what we do for a living. But yeah, it's it definitely, I think it also just helps you be a well-rounded person. And the last thing I'd say is like, thinking about things kind of in the historical context is also helpful. I mean, it's most relevant, I would say right now, it's kind of drawing parallels between GFC, today's environment. Maybe that helps you draw some predictions for what the next few years look like, or going back before the GFC, even just kind of being a student of history and having historical context. I think, I mean, I'm not going to sit here and say that like, we just have this blueprint because we know history. Like everybody reads stuff, but I think it's helpful to have that kind of approach to things.
I think when thinking about history, if I was to pinpoint one professional that uses history to leverage his decision making, I would say it's Ray Dalio, and he does extremely well. I mean, he goes back 500-600 years, whether it's economic cycles, recessions, countries falling, others rising. He built a career around that. So history, I mean, he proved that history does repeat itself. And I do see why there can be a benefit. You think in patterns, because literally everything because people are the same. They tend to make the same mistakes. They tend to expand the same way. It's just the thinking of people hasn't changed in thousands of years, right? So if you can actually narrow down the cycles and what to relate to it in the past, I think you can do very well.
Yeah. No, reading Ray Dalio's take on like what's going on today is it's pretty sobering. As an optimist, some of the things he says I don't want to believe, but I don't necessarily disagree.
So you live in Boise and you're deeply connected with the outdoors, cycling, skiing, spending time in the mountains. How do those personal passions affect your mindset as a leader in the real estate industry?
Yeah, it's a great question. I mean, I would say like those passions have been lifelong passions. So I mean, I'm skied since I was a little kid, and always loved skiing. Always loved riding a bike. I was actually a collegiate tennis player and a junior tennis player, so I did that competitively until end of college. And after college, got more and more into cycling. So even like when I was in LA and when I was in New York, I was always, when I could, getting on the bike. And I'd ride through the city and ride out to Nyack and those places up on the Hudson. But it's always been, here it's a lot easier to do all those things, obviously. And for me, it's been two things. I mean, just like physical fitness and wellness is important to me. And I feel better when I feel like I'm in decent shape and just healthy. I think, I definitely believe in the mind body connection. So that's the first part. The second part is, especially being on a bike, also, a ski day, although it's easier to pull out your phone on a chairlift. But on the bike, I'm not looking at my phone. It's usually a couple hours of no screen time. No, I can think a lot about a lot of different things and kind of have time to just let my mind wander. It's probably the only time, especially like busy career, I have a wife and child at home. Like it's the only time I get to just kind of let my mind wander. And I think a lot about work. I think a lot about life and personal stuff. And I think it creates space to do that, which I think is really important. So yeah, it's kind of twofold, physical and, mental in a way.
How often do you go cycling?
I try to get out every Saturday and Sunday, and usually go pretty early in the morning, get a couple hours in, and then during the week it depends on. I just did a race actually over Labor Day, so I'm kind of haven't been doing as much the last couple weeks, but leading like kind of starting in spring, I'm doing 3 days a week, 3 to 4 days a week, like an hour on an indoor trainer before work.
I know with runners, I don't really run. Me and my brother would like to lift weight. We play volleyball, just high interval training. So I know with runners, there's such thing as a runner's high. Is there a cycling high? Is there such a thing?
Yeah, absolutely. Yeah. It's I mean, it's best on a climb, and fortunately, I mean, I can almost see it from outside our office window here. There's a local ski resort called Bogus Basin, and to get up there from here in downtown Boise, it's only like a half-hour drive, but it's a 17-mile climb on the road. And so we live pretty close by. So, yeah, it's like most of the time I'm just on the road bike riding up this climb. And, it's not like I'm not pinning myself the entire time. Like sometimes I'll just kind of cruise up it. But, if I want to, go a little hard, or if I'm like training for something specific, you definitely get that kind of endorphin hit. You can hurt yourself pretty badly, which is kind of fun.
Yeah, I mean, speaking about hurting yourself, I don't know why my algorithm is this way on Instagram. I keep seeing people get hit by cars cycling, and it's giving this FOMO. I'm not FOMO, but like this fear to go on a bike. I mean, did you ever come across that where you almost got hit by a car, or no, you kind of stay away from them?
Yeah, it's pretty good here. I mean, when I first graduated from college, I was in West LA, working for 4 years and then business school. And I used to ride up PCH up into Malibu, and then they're like actually some of the best cycling in the world, the climbs in Malibu. But to get there, you're on PCH. Like I was like, 23, 24 years old, so I didn't really think much about it, but definitely had some close calls. And New York in the city, it's like you have some close calls, but like you're not going that fast usually. Like, like on the West Side Highway, it's like, somebody walking out in front of you and you just have to hit the brakes. So it's a lot of close calls, but not as high a consequence maybe. But yeah, and then, now the thing is like a lot of people got into gravel biking and obviously mountain biking too. So you're on like more gravel, you're on more rural roads, less traffic, which I like that too.
Yeah, I used to live in Manhattan. We lived in New York for 23 years. Through those
Yeah.
years, I used to live in Hudson Yards.
Yep.
So city bike has been my method of transportation. I think it's the best
Yep.
thing ever.
Totally.
I mean,
Totally.
Uber would take forever. I used to live on 37 and 10. If you want to
Yep.
get to 36 and 2, if you're Ubering, maybe it takes you 35, 40 minutes
Yeah.
just to go just
Oh, yeah.
across the island.
Totally.
Where if you're on a city bike, especially the new ones, electric ones,
Yeah.
you're there fairly quickly.
Yeah, for sure. Yeah, no, it's a great way to get around. The only thing is when the weather's tough, like I don't know, especially when it's hot in the summer, if you have like, the jacket on, you're just sweating. That's
Yeah,
tough.
I mean, yeah, for me, the summers were okay. The tough part was going
Or winter.
uphill
Yeah.
when you're wearing a Parker jacket and the
Yeah.
wind is just blowing to your chest on the West Side Highway.
Yep.
I mean,
Yep. Yep.
I took pictures of my legs. My legs were the most built I've ever been during
Yeah.
this 3 year period when I was cycling upwards in the winters
Yeah. Yeah.
with the wind hitting my chest.
Totally.
So it's a great workout. The heartbeat
Yeah.
just
Oh, yeah.
really goes up.
Yeah. Yeah, absolutely.
So, real estate is often described as a long game. How do you personally balance patience with pressure to deliver results in the short term?
Yeah, I mean, I would say, I'm definitely blessed to have, and some of it was, self-selecting, kind of our team here, our partners here at Roundhouse. We kind of all share the longer term mindset, in the sense that like, what Casey, our CEO, always set out to do was build a durable platform for the long term and not, necessarily like a get rich quick mindset or business plan. And so what that means is, we have a platform that is sustainable through the cycle. We try not to overhire when times are good and then, fire a bunch of people when times aren't as good. We're not immune certainly to, needing to generate kind of corporate revenue through asset management fees, acquisition fees, development fees. That's how we keep the lights on, but the business is set up in a way that it's pretty sustainable and that we don't need, we don't push to do deals just because we need to for the platform's sake. We push to do deals because they're good investments for our investors. And so, fortunate to have that kind of set up here at Roundhouse. And I think we all share, just kind of share that approach to this business. But that said, like, I'm a deal guy and I'm responsible for generating pipeline and executing deals. And, I think I just try to focus on one day at a time and, what can I do to advance this ball or that ball forward? And that looks like, depending on what our pipeline looks like, it's, catching up with people, trying to source new opportunities, trying to get opportunities that we have under contract across the line, trying to set up our asset management team, who I also oversee, for success, on the back end once we've bought a deal, because that's when the real work starts. Monitoring looming or upcoming refinancing opportunities or potential sales, trying to make sure we execute really well on those things, because that's also how your bread gets buttered. And honestly, there's enough in all that to stay really busy on a day-to-day basis. And I think if you get caught up thinking about I want to produce X results and, clip this promote and that promote as soon as possible. And I think you just have to focus on the core goal, which is to build a really durable portfolio, a really durable business. And when you look back over a 10, 15, 20-year period, you're gonna get rewarded financially, which we all obviously all want to be. But I just think if you have kind of that focus of just moving things forward on a daily basis, the latter comes eventually.
Looking back, was there an inflection point for the company that you felt that, okay, we're building something big here? This is not just a syndication house that we're just purchasing and selling a few properties here. We're taking that next step.
Yeah, I'd say last year actually was a big transition for us. It's just a big year. So we, like a lot of groups, we were very cautious in 2023, kind of latter half of 22 and all of 23. We bought one deal in 2023, smaller deal. And, the world was really uncertain at that point. And so it's very difficult to just kind of plow headlong into acquisitions when, interest rates are rising at a precipitous clip, cap rates are also rising, and you don't know where it's all going to settle out. But last year we found a number of compelling opportunities. We felt like things were, kind of settled out enough. We felt like we were not sort of first movers to the buy side or to be buying in that environment, but we were relatively early. And then crucially, we added one in particular, a new family office relationship we had added a couple of years prior, who really well capitalized, really great operation and great partners. And they kind of shared our vision for putting money to work in multifamily in the Mountain West. And so we went from, buying one smaller deal in Montana in 23. Last year we bought 5 deals. We had another 2 under contract by the end of the year. And, we did, with development starts, did close to $1 billion of deal volume in 1 year, which eclipsed our previous record by a pretty tremendous amount. And I think that, I think they're all really good investments, and we're going to do well on those. So I think it's a good vintage. But I think that really got our name out there, got our reputation further in the market. I think it's helping us kind of in our next fundraising journey as we raise this fund, and really just helped us kind of leg up as a business. And I think the last thing I'd say is, crucially, we've maintained kind of our core principles of how we're approaching the business. All the things I mentioned about making sure the business is durable, not growing too fast, making sure we can digest all these acquisitions and new developments. So yeah, that was a real inflection point. I think we were all really pleased with how last year went.
If you were to sum up all the deals that you've done, what would you say your deal volume looks like? I know it's well in the billions. I'm just curious how far in.
Yeah, since I joined Roundhouse, it's probably a little over $1 billion. I think it's probably like $1.1 billion, $1.2 billion, something like that.
And do all the deals go through you now? Is it a system where you have numerous acquisition guys, and then it kind of all goes through you, and you have a final say? What does that look like?
Yeah. So our team's pretty lean still, which is by design. It's me, and then we have a vice president of investments. He and I work really hand in hand. He joined us from an office owner operator. He joined us about 4 years ago. And we work really closely, both on the sourcing side he's probably a little more on the execution side than I am, but I'm still super involved in execution. And then we have 3 analysts on the kind of acquisitions investment side, or 1 associate and 2 analysts, who are, really like in the weeds modeling and executing all our acquisitions. But yeah, really, like I'm primarily the one sourcing. But I mean, our VP Garrett, like he sources deals all the time. Also just, we all have a lot of relationships. So like our C-suite will become aware of stuff. So we don't necessarily, like, we have no kind of hard and fast rule on, so-and-so source a deal, that's their deal. It's really a collaborative, team-oriented approach, and the investments team works on all deals together. So, ultimately, if I'm responsible for it, but we're all very much kind of on the same page and working together.
You've had a pretty interesting journey. What does the next 5 to 10 years look like for you?
Yeah, I mean, I would say I'm very fortunate to feel like, when I landed at Roundhouse, I had hoped this was going to be the case, but you never know, of course. But I feel like this is my last stop on my career journey, and I'm not that old. I'm not even 40 yet, so I got a lot of years left in me, and super super happy and grateful to have found Roundhouse when I did, and be able to kind of be a part of building this team, building this company. I'd say, the next kind of 5-10 years doesn't look super different from the last 5 years. We'll just be doing, we'll have kind of just more, right? We'll have, probably a slightly bigger team. We'll have more capital relationships, be able to hopefully do, a little bit greater deal volume, and expand hopefully to some new markets. And just continue to improve our processes and our methods, and be like, our goal is not to be the absolute biggest multifamily investment development shop. We want to be, Casey has a great saying, is like, we want to be the Patagonia of multifamily real estate. Like, we just want to be known as like really high quality, not necessarily everything to everyone. If you want specific investments in specific areas, we think we're really good at doing that, and we want to continue to offer that to more and more investors. But ultimately, we just want to make sure we're executing really well, and we're known for super high quality investments and interactions and service.
Absolutely. No, I'm looking forward to seeing what the future has in store for you. Michael, thank you so much for coming on this podcast. I would love learning about you, love learning about Roundhouse, and very curious to where your career goes next.
Yeah, I appreciate it a lot. It's good to be with you guys, and yeah, I'll keep you posted.
Yeah,
Thank you
we'll
for coming
definitely
on.
stay in touch. All right. Thank you so
Sounds
much.
good. How you going?
All right.